All right, joining me is David Dziekanski, CEO and Chief Investment Officer at Quantify Funds, who last month they launched a very interesting ETF. So it's called the STKD, as in stacked Bitcoin and Gold ETF. The ticker symbol is BTGD. And we'll get into this, but in a nutshell, for every $1 invested, this seeks to offer a dollar of exposure to Bitcoin and a dollar of exposure to gold. So this is what's called return stacking. We'll get into that as well. But David, thank you for joining me. You know, I feel like I've known you for a long time in the ETF space. It's great to connect here, sort of in my crypto sphere.
Yeah, thanks so much for having me. It was a number of years ago. I was on your ETF podcast talking about another product, but we're very happy to come to market here today with the Bitcoin and Gold ETF and think the timing is absolutely perfect for this trade. You saw even JP Morgan deem 2025 the currency debasement year. And so we'd like to think this is a nice prepackaged currency debasement hedge in a single ETF.
Okay, so I'm going to start you out with a point of debate, at least that I see. So if you're out on X like I am, there seems to be some debate within the crypto community. And the way I would describe this is that I feel like there's one camp who views Bitcoin as actually being very similar to gold, right? It's a longer term store of value. It's outside the purview of any single government, doesn't depend on any particular financial institution. It's self-sovereign, all of those things. But then I feel like there's another camp who sort of pits these two against each other. They would say Bitcoin is a significant evolution of gold, right? It's digital gold. You don't have to store gold bars in your basement. You can transact whenever you want. And when I think about your ETF, which we'll get into, obviously you're combining both of these assets into a single product. So I'm assuming you think there's investment merit in both. But let's start there. How do you like to compare and contrast Bitcoin and gold?
Yeah, whenever there's a big movement in the investment world, there's definitely going to be some truists who are, fully in one camp or the other. I think if you think that Bitcoin is going to replace all paper currencies, that's the camp that can't really see the logic between tying Bitcoin and gold. But if you think about it from an allocator's perspective, where are you considering putting Bitcoin and gold in your portfolio? They really fit in the same bucket, right? They don't fit in equities. They don't fit in fixed income. They're kind of alts. So what are they within the alt space? And that's where we really think this linkage of like hedge against currency debasement makes a lot of sense. These are scarcity assets that aren't being created at the same pace that currencies around the world are being created. Bitcoin has a replacement rate of about 86 basis points a year post-halving, and that's not taking into consideration any lost coins, which obviously is happening at a slower frequency, and gold mines at about a 1.75% rate per year. So the question is, what scarcity assets are there, and where would you allocate to this in an institutional portfolio? And it's our feeling that it would both be in this almost like currency debasement alternative portion of your portfolio.
You know, it's funny. I don't know if you saw this, but somebody called Bitcoin gold as a teenager, which I love. I don't know if you agree. I can't remember if that was Bloomberg's Eric Balchunas or maybe it was Jan Van Eck, but I thought that was probably a pretty good characterization. It's just early, right? But to your point, these are assets to hedge against debasement. I guess on that note, and again, we'll get into the mechanics of the ETF in a moment, but where did the idea for this ETF come from overall? Was it with what you were just describing in terms of how you view these assets? Was there more to it? Where did this idea come from?
Yeah, so I've been a firm believer in allocations in both Bitcoin and gold for quite some time. The inception of STKD Bitcoin and Gold ETF actually came from our now partners in this lineup, the Return Stack folks, both with Newfound and Resolve. They are 2 years into the portable alpha category in the ETF space, stacking indexed hedge funds on top of asset classes such as the S&P 500. I thought of this idea incepted from their brand. I've known Corey for about 15 years, so he was the first person I called. I first asked for his blessing, and then I asked for his partnership, just because I feel like that's a good way to do business. So.
Yeah, and those return stack ETFs have had a lot of success here early on. It's impressive what Corey Hofstein and the team are building out there. On that note, explain the concept of return stacking or portable alpha. And I'll tell you, David, for whatever reason, my experience has been that this can be somewhat difficult for people to get their head around. But I do feel like once somebody gets it, it's like, it clicks, a light bulb goes off, and it's actually a very simple concept. You just have to get your head around it. So how do you like to explain return stacking?
Yeah, so return stacking, portable alpha is an institutional strategy that's been used for decades that is now being released in the ETF wrapper. It is the process of stacking two different assets on top of each other, hopefully assets that have some diversification benefit. And this really delineates this whole category from traditional leverage ETFs. Traditional leverage ETFs have that cigarette warning of daily use, intended for daily use, and that's because there's no mechanism to rebalance between anything within the portfolio. We all know that leverage ETFs does not create a traditional form of leverage on a portfolio. It needs to be managed to maintain your leverage ratio, and leverage ETFs tend to be very path dependent. So if anything to take away about portable alpha, capital efficient strategies, the idea is to have this piece of leverage that is a little bit less path dependent. And that's because you have two assets within the portfolio that you can rebalance between each other that allows for a little bit less path dependency over the course of time of holding a product like this.
Explain the capital efficiency component, though, because as I noted at the top, if you invest $1, you're getting $1 of exposure to Bitcoin, $1 of exposure to gold. Why is that beneficial in the context of a portfolio? Why do you want that?
Yeah, absolutely. So the institutional world finds an optimal mix of assets and then applies an appropriate amount of leverage on it. Every institution runs at a different leverage ratio, but even if it's as simple as a 10 to 25% increase in exposure to your overall portfolio, if you're gaining that additional exposure via assets that can be diversified to the rest of your portfolio, it's accretive to your portfolio. So the idea here is to allow you to run your portfolio a little bit more like an institution would, and get access to margin through the futures rates. Whether you're an individual or an RA trying to get good margin, for example, from an RA across an entire book of business is very, very hard to do. So this is one of the capital efficient portable alpha tools that are available to advisors and individuals to get that portfolio level margin, accessing margin through the futures markets.
And I don't want to belabor the point, but talk more about the leverage component itself, because as you know, and I would say especially with retail investors and certainly advisors, leverage can be a dirty word in investing, right? People hear leverage and they automatically associate it with additional risk. So I just want to make sure people are really crystallizing this concept of return stacking and capital efficiency. So just talk a little bit more about the leverage component and why it doesn't necessarily need to be viewed as additional risk in a portfolio.
Yeah, and to be clear, there'll definitely be more volatility when you're leveraging two different assets on top of each other. But the idea is you have less volatility than if you added each individual asset independently. And that's where the rebalancing between negatively correlated assets really comes in and lowers the overall volatility. We got compared in one piece to just a 2x Bitcoin and a 2x gold ETF, and asked what the difference was between our strategy and that. And really the difference is the rebalancing mechanisms that happen within the portfolio that allow you to benefit from the randomness of price movements. And we've seen it live here today in the last couple of weeks. Since the election, you've seen Bitcoin absolutely skyrocket. Gold has pulled back significantly. That allows us opportunities to rebalance between the two assets. Bitcoin won't go in one direction till the end of time, right? At some point, there will be a pullback. We'll be able to harvest that pullback as well, and then rebalance back further into Bitcoin.
And I always like to boil things down to the very basics. So let me give you just a high level example, and you tell me if this is correct. So you've already described why pairing Bitcoin and gold together may be beneficial, but if I were to just really simplify this, if somebody, say, had a 5% allocation to gold in their portfolio and a 5% allocation to Bitcoin, what they could do through your ETF is just take a 5% allocation into your ETF, and they have the similar exposure. Then they could take that other 5% that's now freed up, and they could use that to pursue additional alpha or further diversify the portfolio. I mean, is that, if I were to boil it down very simply, is that a fair characterization?
Absolutely. We've seen a lot of adoption with BTGD, as you just stated right there, sitting next to an alternative. everyone's trying to figure out how to get alternatives into your portfolio. This is a way to free up allocation so you can put a market neutral strategy, a managed future strategy, or anything alongside this. And again, I think a lot of the capital efficient space is just trying to figure out how to further diversify from equities without drawing from equities specifically, right? Equities have been the trade of the last 15 years. Everyone is terrified about lowering their equity exposure. How do you still get ample diversification in the allocation that you have left outside of your equity bucket?
Okay, so the stacked Bitcoin and gold ETF, again, ticker BTGD, you've alluded to what it holds, but just walk us through the basic mechanics here. What exactly does it hold? How does this work?
So the ETF is comprised of futures in both Bitcoin and gold, as well as exchange traded products in the Bitcoin and gold space. We use the combination to, one, get maximum efficiency of leverage from the futures markets and cost efficiency of rebalancing from the ETFs, which allows us to rebalance on a drift between the two without necessarily causing us to trade in the futures markets, which is obviously a lot cheaper of a trading cost. So the idea is if there's any significant drift between Bitcoin and gold, we will rebalance between the two, not on a daily basis, usually about like once a week.
And to be clear, again, I always like to boil things down to the basics. The reason why you're using Bitcoin futures and gold futures is that's how you obtain the leverage in the ETF, right? Because I think some people, they're going to look at this and go, why doesn't it own the actual underlying spot asset? But it's because that's how you obtain the leverage.
Absolutely, yeah.
Okay, and what about the cost? You briefly noted this before, but obtaining leverage in any form is not free. And so what do those underlying costs look like?
Yeah, futures markets are one of the most efficient forms of leverage in this world. So you're going to pay some spread over short-term rates, but it's going to be kind of as competitive a spread as you can. And when you take a Bitcoin futures and a pile of cash that sits next to it, that return stream should return almost exactly what Bitcoin does over any given period. Obviously, there's potential for contango and backwardation in futures markets. What we've seen is there's very little of that in the gold market, and it only really starts to exist in the Bitcoin space once you go past the first month contract. So we stay very much close to the first month contract. It is an active strategy. We can obviously choose to go to other contracts if we think it's beneficial. But the idea here is to have as little slippage as possible and just represent the price return of Bitcoin and gold collectively minus the cost of financing between the two.
And for people who aren't familiar with what contango or backwardation is, we're going to step back to, or at least I'm stepping back into the ETF sphere. Do you want to just explain high level what that is? It doesn't sound like it's overly impactful in this particular product, but I think it's good for people to understand.
Contango and backwardation is just the cost of holding a futures contract, whether that futures contract is above or below the spot value. In certain cases, it's tied to the actual cost of storage. And in other cases, it's very much tied to speculation on the underlying asset and expectations for price over time. So it definitely makes it a lot harder to represent the underlying return of an asset if there's significant contango or backwardation. And I think in the infancy days of the futures markets in Bitcoin, there might have been a little bit more. But again, especially right now in the first month contract, we're seeing very, very little of that.
So going back to where we began this conversation, I think it's clear your belief is that Bitcoin and gold, they don't have to be in competition with each other, right? When it comes to a portfolio allocation, you can have both. Just at a high level, and I'm not asking you to offer up back-tested data or anything like that, but can you just offer some additional context as to what an allocation of Bitcoin and gold would bring to a portfolio? And again, we've touched on this a little bit, but I really just want to make sure people understand what the investment thesis is here.
Yeah. And we're working on a white paper that we'll release with some actual back tests looking at daily rebalancing. What I can allude to is the correlation benefits between Bitcoin and gold seem to hold up very well, especially when Bitcoin has a lot of volatility. So if you look at the last two quote unquote crypto winters, and you look at the max drawdown of Bitcoin over the crypto winters, gold held up quite well over those winters, an average of about minus 2.5% returns over both winters. But gold was actually up in the first half of both crypto winters and then pulled down a little bit in the second half, which meant the rebalancing mechanism built into this strategy actually added a lot of value. The max drawdown of the combination of Bitcoin and gold, even with the cost of leverage, was about 103% the downside of just Bitcoin alone. So unlike traditional leverage ETFs where you get that exacerbated downside, so far historically the diversification benefits between Bitcoin and gold have allowed it to not really increase the volatility that much on the drawdowns that we've seen in Bitcoin. And really that outsized volatility you get from the leverage has really shown much more on the upside.
Any thoughts out of on what we've seen out of Bitcoin here recently? I mean, you look over the past week, up what 25-30% last I checked. It moves fast, but any thoughts on what we've seen here?
Yeah, Bitcoin has definitely been shown to be the favored Trump trade post-election. And what I think we're really seeing here is obviously a governmental acceptance and adoption of Bitcoin and cryptocurrency, as well as expectations of larger budget deficits. If you look at any numbers coming out of the government, whether you expect it to be true or not, the going thesis is that Trump will actually have slightly higher deficits for a number of reasons. So I think you're seeing inflationary assets, equities, Bitcoin really rally with that, whereas traditional safety assets are not faring as well, whether it's 10-year treasuries or gold. But that's one of the benefits of this strategy. Right now, Bitcoin is being seen as a growth asset and being adopted by the largest country, biggest government in the entire world, whereas gold is trading a lot more like fixed income. But that time will change. We saw that, for example, during SVP. There'll be times, and that Silicon Valley Bank, there'll be times when Bitcoin trades much more like a defensive asset, much more aligned with gold. We think that might even happen in times of some market volatility. But I think both assets, again, still play to the currency debasement trade. They just do it in a little bit of a different way. And as you said, it's really like DeFi versus TradFi. And I think that fight back and forth allows for a lot of opportunity for us to rebalance between the two.
Obviously, we've been focusing on Bitcoin here. And by the way, I've got to be very careful with the crypto community. We can't refer to Bitcoin as crypto.
Yes.
I don't know if you know, those are two completely different categories. But on that note, if we move away from Bitcoin and just look at the broader crypto ecosystem, do you have any strong views there? Are you a proponent of what's happening there? Do you view it all as, sort of the Wild West and, there's meme coins and NFTs? I'm just curious, high level, how do you view the crypto ecosystem?
I'm a big fan of the blockchain and how that gets applied to different industries, whether it's the stock industry or being able to use it in an industry such as the art world or car world, where you're actually assigning a specific coin to a specific option, so you can get rid of like fraudulent bags and things of that sorts. I do think that for us specifically, the most intriguing thing about Bitcoin is the scarcity. So that's some of the things we are trouble wrapping our heads around with some of the other cryptocurrency coins, is they don't really have that level of scarcity. But we're big proponents of Bitcoin, of the blockchain space and what it'll do to the business world and the efficiencies that it'll create. One person said it very well. It's almost like we went from a two-party accounting system to like a three-party accounting system where both sides don't have their own ledger. The entire world has the ledger of all these transactions that happened, and the efficiencies that can happen in that world we think are huge.
Real quick before I let you go, and I don't know if you want to speak to this or if you even can speak to this, so free pass here if you don't want to, but I'm curious, might we see additional stacked ETFs from Quantify? So I don't know, perhaps a stacked Bitcoin and Ether ETF or some iteration of that. And I know you described earlier that you're looking for assets that are, there's some diversifying qualities between them in the portfolio. But is there anything on the product roadmap that you can tell us about?
Yep. I obviously can't comment on product specific things, but we definitely have a number of things in the work that we think will come out in the next couple months. So please stay tuned. And also, we're looking for opinions from the crowd. So if you could email us at info@quantifyfunds.com. What do you want to see stacked? That's what we want to hear from you. And we're very eager to see the results that you guys send in.
Well, I love it. Congratulations on the launch of the ETF. Looks like it's off to a great start so far. So congrats on that. Best of luck to you. And thank you for joining me.
Thank you, Nate. Always a pleasure. Thank you so much for having me.
That was David Dziekanski, CEO and Chief Investment Officer of Quantify Funds. Really hope everyone enjoyed this episode of Crypto Prime. Please be sure to leave a review or give us a like wherever you're listening or watching. I always appreciate that. This podcast is available everywhere, Apple, Spotify, YouTube. So please leave a review, and thank you for listening.
Crypto Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of the investment advisory firm The ETF Store. While OTR Media LLC and the ETF Store are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by the ETF Store. This program is for informational purposes only and does not constitute investment advice. Investing in crypto assets involves substantial risk, including the potential loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Visit CryptoPrimePodcast.com for more information.